Imagine a wild frontier town, full of gold rush speculators and just total chaos. And then overnight, paving trucks roll in and banks open up on every corner. That is, well, exactly what happened to the markets this week. Welcome to today's deep dive into the June 16th, 2026 news stack. We are analyzing a massive structural shift.
Right. The market definitively maturing from this speculative arena into a structured, institutionalized financial pillar.
Okay, let's unpack this. Look at how the market just absorbed a massive macroeconomic shock. The Bank of Japan raised interest rates to 1%.
Which historically violently disrupts the yen carry trade, like that strategy where funds borrow cheap yen to buy higher yield risk assets.
Exactly. I mean, if you were watching the charts in December 2025, a hike like this caused a 32% market collapse because everyone had to suddenly sell their assets to pay back those yen loans.
Yeah. But this week, the market barely flinched. It bounced right off a $65,595 support floor.
Wait, how did we actually survive that without a crash?
Well, the options market is finally mature. Traders had already priced in like a 98% probability of the rate hike, so the institutional plumbing was completely ready.
Oh, so instead of a panic sell-off, it triggered a short squeeze.
Yeah. People betting against the market were forced to buy back in, liquidating $375 million in short positions. Add in the U.S. lifting its naval blockade in the Strait of Hormuz.
Dropping Brent crude prices by 4%, right. So global central banks suddenly have immediate breathing room on inflation.
Exactly.
I'm struggling to square this circle, though. You're saying institutional plumbing absorbed a massive macro shock effortlessly. But if I look at the fear and greed index right now, it's sitting at 23. I mean, that is extreme fear. If you are an investor looking at your portfolio this week, you might be wondering why everyone is still panicking if the paved roads are actually working.
It is a really fascinating split screen. Retail investors are still, reacting emotionally to headline volatility. They feel the fear.
But institutional mechanics don't feel fear.
Right, they run on algorithmic logic. The automated buy walls in the mid-65,000 range just absorbed that selling pressure effortlessly while retail panicked.
And those institutional mechanics aren't just playing defense. They're building massive onshore infrastructure to capture predictable revenue. Take BlackRock filing for the BITO ETF, which launches June 18.
Yeah, they are using a covered call strategy on their existing IBIT fund to generate monthly dividend yields.
It's exactly like renting out a house instead of just leaving it empty and waiting for the property value to rise. You intentionally sacrifice that explosive upside for immediate, predictable cash flow.
Which is exactly what traditional asset managers demand. Kraken and Coinbase are doing the same thing, shifting massive trading volumes onshore with new CFTC-regulated perpetual futures.
And for you listening who might not trade them, a perpetual future is essentially a bet on an asset's price direction that never expires. Moving these onshore builds the regulated guardrails that make traditional finance comfortable.
Right. And that demand for predictability. It's completely rewriting the corporate playbook, too. Companies are aggressively de-risking. You have Fold and Nakamoto liquidating assets to just completely eliminate debt.
Plus hyperscale data holding 73% of its market cap in liquid treasury, and Metaplanet acquiring Saibo Securities to issue Bitcoin-linked corporate bonds directly in Japan.
Oh, and the FTX bankruptcy claims window just officially closed, clearing the way for those July 31 payouts.
Wow. So the broader market is demanding stability over shiny new tech hype. I mean, Botanix actually shut down its spider chain because there's just zero institutional demand for native smart contracts.
Exactly. While Circle launched SurBTC to bridge liquidity directly to Ethereum, we are seeing real utility thrive where it solves actual problems.
Like overseas, right?
Yeah. In Nigeria, there were $59 billion in stablecoin inflows over the last year, and now Ripple and Flutterwave are partnering to expand those local payment rails.
Meanwhile, stateside, the CFTC and DOJ are aggressively cracking down on prediction market wire fraud.
Right. They are bypassing standard securities laws to charge a former engineer with wire fraud over prediction markets. It signals regulators are using traditional legal frameworks to sanitize the space.
So what does this all mean? Are we seeing boring compliance and utility definitively win out over the Wild West hype?
Institutional players demand boring, because boring is predictable, and predictability scales.
So the real edge for you as an investor today isn't just watching price action 24/7, it's understanding these traditional finance mechanics and global regulatory shifts.
The frontier town has its banks and its paved roads now.
But it leaves you with this to chew on. If Wall Street products like BETA cap the asset's upside just to provide fiat yield, Will the original vision of an alternative financial system eventually just become another yield-bearing row on a traditional banking spreadsheet? Something to think about as you navigate the paved roads of this new frontier.